Hello students, welcome to the lecture on risk and return analysis, and after this lecture we will be able to learn the following objectives. Explain the concept of risk and return, discuss the diversification of risk, define the risk and return of single assets, explain the return and risk of portfolio, discuss the capital asset pricing model CAPM, and define the risk evaluation methods. Concept of risk and return. Let us first understand the meaning of return. Return is the motivating force and the principal reward in the investment process. It is the key method available to investors in comparing alternative investments. The main concepts of risk and return are elements in return. Return on a typical investment consists of two components: periodic cash receipts, change in the price of the asset. The income from an investment consists of one or more cash payments paid at specified intervals of time. Total return consists of the sum of two components, income and price change. Total return is equal to income plus price change plus minus. Return measurement. Returns across time or from different securities can be measured and compared using the total return concept. The total return for a given holding period relates all the cash flows received by an investor during any designated time period to the amount of money invested in the asset. It is defined as total return is equal to cash payments received plus price change over the period. Purchase price of the asset. The price change over the period is the difference between the beginning price and the ending price. Return applications. The total return is an acceptable measure of return for a specified period of time. The geometric average return measures compound, cumulative returns over time. It is used in investments to reflect the realized change in wealth over multiple periods. The geometric average is defined as the nth root of the product resulting from multiplying a series of returns together. G is equal to 1 plus R1 into 1 plus R2 to 1 plus Rn, 1 oblique H minus 1, where R is equal to total return, N is equal to number of periods. Diversification of risk. The ways for diversification of risks are risks in a traditional sense. Risk in holding securities is generally associated with the possibility that realized returns will be less than the returns that were expected. The source of such disappointment is the failure of dividends, interest, and/or the securities price to materialize as expected. Systematic risk. Systematic risk refers to that portion of total variability in return caused by factors affecting the prices of all securities. Purchasing power risk. Purchasing power risk is the uncertainty of the purchasing power of the amounts to be received. In more everyday terms, purchasing power risk refers to the impact of inflation or deflation on an investment. Unsystematic risk. Unsystematic risk is that portion of total risk that is unique or peculiar to a firm or an industry above and beyond that affecting securities markets in general. The uncertainty surrounding the ability of the issuer to make payments on securities stems from two sources: the operating environment of the business and the financing of the firm. Business risk. Business risk is a function of the operating conditions faced by a firm and the variability these conditions inject into operating income and expected dividends. Business risk can be divided into two broad categories: external and internal. Internal business risk is largely associated with the efficiency with which a firm conducts its operations within the broader operating environment imposed upon it. External business risk is the result of operating conditions imposed upon the firm by circumstances beyond its control. Financial risk. Financial risk is associated with the way in which a company finances its activities. Financial risk is avoidable risk to the extent that managements have the freedom to decide to borrow or not to borrow funds. A firm with no debt financing has no financial risk. Assigning risk allowances, premiums. One way of quantifying risk and building a required rate of return R would be to express the required rate as comprising a riskless rate plus compensation for individual risk factors previously enunciated, or as R is equal to I plus P plus B plus F plus M plus 0, where I is equal to real interest rate, riskless rate, P is equal to purchasing power risk allowance, B is equal to business risk allowance, F is equal to financial risk allowance, M is equal to market risk allowance, O is equal to allowance for other risks. Stating predictions scientifically. Security analysts cannot be expected to predict with certainty whether a stock's price will increase or decrease, or by how much. The amount of dividend income may be subject to more or less uncertainty than price in the estimating process. The deviation of any outcome from the expected return is outcome minus expected return.
Strategic risk is probably one of the hardest ones to get your head around. But it's those big macro things that people don't normally think about. For example, if we as an employer aren't thinking about the kind of people we need in 2 years' time and training and developing them, the risk is, and doing something about it now, the risk is that we find out in 2 years' time we haven't got the people we need to run a business. So that's like a strategic risk. Well, I mean, strategic risk, there are many strategic risks. So, for example, we've seen the government has done some big spending cuts recently, and they're saying they're going to change the law in all sorts of ways. And that brings huge risks. So, for example, for academic institutions, universities, etc., they're finding that the funding structure for students is changing altogether. Those are huge strategic risks that they can do very little about, apart from worry, maybe plan a little bit. But that's a good example. And a new government might change the risk back and say, okay, we'll go back to grant funding and in the future, and that's probably a strategic opportunity more than a risk, but you never quite know where these things will go at times. Well, an example of financial risk is not getting paid. That's a classic one. So if we as a business, we go to customers that aren't solid or aren't reliable or perhaps haven't got a good balance sheet or not financially solid, we might find that they go bust or they don't pay us because they don't want to. So that's a classic example of financial risk. Operational risk, well, clearly the classic operational risk in health and safety is health and safety orientated, looking after our people and making sure we don't hurt people as we go through and run our business. But there's a whole host of different operational risks, and I think as a classic example, if we're delivering a contract for a client, a customer, we might find that a small shipment or a small delivery doesn't arrive and it upsets the whole contract and the whole delivery. So you've got to think about where those risks might be and what you would do just in case that happened. What will we do? How will we solve the problem?
Risk and return of single assets. We are expecting our money to grow with time, and for that to happen, the sacrifice of current income that we make today should provide us some reward in the future. We call this reward return. Just as we can hope to earn a positive return on our investments, we must also be willing to take a chance that they might turn out to be negative. We can refuse to take that chance and avoid investing. It follows that our willingness to tolerate a certain degree of risk translates into a possibility of earning a positive return, and the more risk you can bear, the more return you expect to earn. Sensitivity analysis. Sensitivity analysis is one of the simplest ways of handling risk. It consists of examining the magnitude of change in the rate of return for the project for a small change in each of its components which are uncertain. Objectives of risk analysis. A project's qualitative risk assessment will recognize some risks whose occurrence is so likely or whose consequences are so serious that further quantitative analysis is warranted. A key purpose of quantitative risk analysis is to combine the effects of the various identified and assessed risk events into an overall project risk estimate. There are at least 5 criteria to help select a suitable quantitative risk technique. The methodology should be able to include the explicit knowledge of the project team members about the site, design, political conditions, and project approach. The methodology should allow quick response to changing market factors, price levels, and contractual risk allocation. The methodology should help determine project cost and schedule contingency. The methodology should help foster clear communication among the project team members and between the team and higher management about project uncertainties and their impacts. The methodology should be easy to use and understand. Probability distribution. Probability may be described as the measure of likelihood of an event's occurrence. The risk associated with an asset can be assessed more accurately by the use of probability distribution than sensitivity analysis. Standard deviation. The most common statistical measure of risk of an asset is the standard deviation from the means or expected value of return. It represents the square root of the average squared deviations of the individual returns from the expected returns. Coefficient of variation. The coefficient of variation measures the variability of a series of numbers independently of the unit of measurement used for these numbers. In order to do so, the coefficient of variation eliminates the unit of measurement of the standard deviation of a series of numbers by dividing it by the mean of these numbers. CV is equal to sigma R 1 by 2. Return and risk of portfolio. The average return level is usually described by the expected value of the return, and the risk is usually described by the variance of the return. The variance of returns can be used as a measure of risk if we are evaluating the entire portfolio of investments that an investor has. The return on a portfolio of assets is calculated as where Ri is the expected return on asset I and Wi is the weight of asset I in the portfolio. Portfolio risk is calculated using the risk of the individual assets measured by the standard deviation, the weights of the assets in the portfolio, and either the correlation between or among the assets or the covariance of the assets' returns. For a two-asset portfolio, the risk of the portfolio sigma p is where sigma I is the standard deviation of asset I's returns. Rho 12 is the correlation between the returns of asset 1 and 2, and cov 12 is the covariance between the returns of asset 1 and 2. Capital Asset Pricing Model CAPM. The Capital Asset Pricing Model CAPM describes the relationship between risk and expected return, and it serves as a model for the pricing of risky securities. The CAPM says that the expected return of a security or a portfolio equals the rate on a risk-free security plus a risk premium. The commonly used formula to describe the CAPM relationship is as follows. Required or expected return is equal to RF rate plus market return minus RF rate star beta.
CAPM, Capital Asset Pricing Model explained in 3 minutes. Imagine you have a friend named Bob with his money safely deposited in a bank at a 5% interest rate per year, and that you have a scary and risky company which also earns an average 5% profit for owners or investors per year. Can you convince Bob to withdraw his money from the bank and invest in your business? No way! If your business is riskier than the bank, then Bob would want an average return much bigger than 5%. Now what if Bob also has some money invested in the general stock market, which is kinda risky, but not as risky as your scary company, and he earns an average profit of 8% per year? Can you offer Bob also 8% to convince him to sell his stock market portfolio and invest in your company instead? Again, no way! If your company is riskier and scarier than the general stock market, then you would have to offer Bob an average return much higher than 8% to reward Bob for his higher risk. So the question is, exactly how much average percentage return should you offer Bob to make his investment worth his risk in your scary company? This percentage is called your cost of equity, and we calculate it using the CAPM, or Capital Asset Pricing Model formula. Don't panic, it's much easier than it looks. The Capital Asset Pricing Model, or CAPM formula, factors in Bob's risk and return from his other investments, and then tells us how much Bob should reasonably expect from your riskier company. That's why your cost of equity is also called your investor's expected return.
Risk evaluation methods. Risk evaluation allows you to determine the significance of risks to the business and decide to accept the specific risk or take action to prevent or minimize it. There are some tools you can use to help evaluate risks. Subjective and objective methods of evaluating risk. There are two basic methods of evaluating risk: the subjective or qualitative method and the objective method. Qualitative method allows an individual or group to provide opinions on the riskiness of a particular situation without resorting to past data. Quantitative methods rely on the examination of past data and assume that this can be projected into the future to establish a means of measurement of the risk concerned. Certainty equivalent method. It is yet another common procedure for dealing with risk in capital budgeting is to reduce the forecasts of cash flows to some conservative levels. The certainty equivalent approach may be expressed as net present value is equal to the risk adjusted factor X, the forecast of net cash flows, upon 1 plus risk free rate. The certainty equivalent coefficient can be determined as a relationship between the certain cash flows and the risky cash flows. That is, risk adjustment factor is equal to certain net cash flow upon risky net cash flow. Decision tree method. Decision tree method is an analytical approach to making decisions, especially those that have the potential to be risky or costly. The method uses a graphic known as a decision tree that presents a set of competing alternatives as separate branches. Features. The decision tree diagram consists of nodes and connecting branches. The nodes, displayed as small squares or circles, represent decision points such as whether to invest in new technology or whether to construct a new production facility. The connecting branches represent each possible choice or outcome related to the node to which it is connected. Function. Decision makers can use the decision tree method in medical diagnosis, game theory, engineering, public policy analysis, business management, and more. Benefits. The decision tree method is a visual, easy to understand alternative to the numerical charts and statistical probabilities in other decision analysis methods such as spreadsheets. Decision trees also are adaptable. Considerations. Every decision involves a level of uncertainty. An investment in new technology may not yield the hoped for benefits. Analysis and decision. After graphing all decision alternatives along with corresponding probabilities, benefits and expected values, decision makers can analyze the decision tree and identify the best course of action. A completed decision tree will visually display the sequence of decisions required for each set of alternatives. Summary. Now in the end, let us summarize what we have learnt in this lecture. Return is the motivating force and the principal reward in the investment process. Business risk is a function of the operating conditions faced by a firm and the variability these conditions inject into operating income and expecting dividends. Financial risk is avoidable risk to the extent that managements have the freedom to decide to borrow or not to borrow funds. The capital asset pricing model, CAPM, describes the relationship between risk and expected return, and it serves as a model for the pricing of risky securities. Decision tree method is an analytical approach to making decisions, especially those that have the potential to be risky or costly.